Today we're going to be learning about mortgages. Archibald is a loan officer at a bank. He specializes in long-term loans called mortgages, in which property is used as security for a debt. A young couple has decided to purchase a townhouse at the price of $240,000. They have applied for a conventional mortgage from Archibald's bank. Because the townhouse is older, the bank is requiring a 20% down payment. Special interest of mortgage loan of 55% is being offered. The bank is also requiring 2 points for their loan at the time of closing, the final step in the sale process. Charging points enables the bank to reduce the interest on the mortgage loan, which will reduce the monthly payments. So determine the amount of the down payment. This amount is paid to the seller at closing. So the house is for sale at $240,000. And they're going to have to pay a 20% down payment. So that comes out to $48,000. If the couple agrees to pay for private mortgage insurance, or PMI, the bank can lend up to 95% of the value of the property. What would be the down payment if the bank required a 5% down payment? So $240,000 again times 0.05 means they would only have to pay $12,000 as a down payment. And as a new couple trying to buy their first house, $12,000 is probably a lot more doable. So, assuming they agree to purchase the PMI, what is the amount mortgaged? So the house is $240,000, but they're going to pay $12,000 of that up front, so they'll have to borrow $228,000 from the bank. A point is 1% of the amount to be borrowed and is paid to the bank at closing. Determine the cost of the points for the loan. So they're borrowing $228,000. They are getting 2 points, which would be 2%. So they would have to pay $4,560 to the bank when they close on the house. Use the TVM solver to determine the monthly payment for a 30-year mortgage. So a mortgage you pay every month. So for N, we would have to take the 30 years and multiply it by 12, which gives us 360 payments. It's a 5.5% interest loan. They're borrowing $228,000. We're looking for our PMT. Our FV is 12. FV is 0, PY and CY are 12 because we're making monthly payments, and we'll make them at the end. So if we put all this in our app, 360 payments, 5.5 interest, they're borrowing $228,000. So their monthly payment would be $1,294.56. So what is the total amount of interest paid? They are going to pay $1,294.56 360 times, but we have to deduct that they borrowed $228,000. If we type that into our calculator, it comes out that they paid $238,041.61 or 60 cents in interest. So basically, they paid more in interest than they did for the loan. So basically, they paid twice as much for the house. So let's look at what having different lengths of mortgages does to our monthly payments. So if I have a 15-year mortgage, my N would be 15 times 12. And if I go down here, that changes my payment to $1,862.95. But if I pay $1,862.95, I'm going to pay it for 15 years times 12 times a year minus the $228,000 that I borrow. Now I pay $107,331 in interest. If I take the length of the mortgage up to 20 years, my monthly payment is $1,568.38, and my total interest would go up to $148,441.20. If I go to 25 years, my mortgage would be $1,412, and my interest would be $192,036. And the 30 year we already calculated would be $1,294.56 for a total interest of $238,041.60. So, what is the effect of the monthly payment and total interest paid as the length of the mortgage increases? So as the length increases, the payment decreases, but the interest increases. So basically, the faster you pay it off, the better you'll be, the less you end up spending. However, you might not be able to afford $1,862, so you might have to find a nice balance of what monthly payment you can afford and paying it off fast enough so that you don't spend an excessive amount of interest. So, an amortization schedule. This is a list of payments, interest, and account balance. So the bank would keep track of this, and they'd send you statements every so often showing how you're paying off your loan. So the couple decides on a 30-year mortgage in order to have the lowest monthly payments. Archibald explains to them that the monthly payment is applied to interest on the loan and to reduce the amount owed. The couple asks Archibald if the $1,294.56 monthly payment is divided equally between reducing the amount owed, the principal, and paying the interest. The calculated monthly payment for the couple's 30-year $228,000 mortgage at 5.5% is $1,294.56. Determine the outstanding balance at the start of the second month. So interest can be calculated using this formula. It's the outstanding balance times the interest rate divided by 12. So the first month, the couple would send their monthly payment to the bank. Using this formula, I'll show you. So the outstanding balance is $228,000 times 0.055%, or 0.055 is 5.5% as a decimal, divided by 12. The interest is $1,045. So that's what they're going to pay first. The $1,294.56 minus the $1,045, so the remaining about $250, goes towards what they owe the bank. So month number 2, they're going to send $1,294.56 again. They still owe $228,000 27750.44 times 0.055 over 12. So this month they're charged $1,043.86 in interest. So that means of their payment, they're left with $250.70 to reduce their principal. So now their loan is down to $227,499.74. So then month 3 rolls around. They're going to send them $1,249.56 again. Using the formula, the interest they owe that month is $1,042.71, which means they'd have $251.85 to go to the principal, meaning they still owe $227,247.89 to the bank. So then month 4, still sending the same monthly payment. Our interest is now $1,041.55, which means $253.01 can go towards the principal. So our loan is now down to $226,994.88. So even though they sent over $1,000 each month, it took 4 months for their balance to actually reduce by $1,000 because of the interest charged. So as the number of payments increase, the monthly payment stays the same. The interest is going to decrease because you owe less, so the amount that reduces the principal increases, and the end of balance decreases. So let's see if the couple qualifies for the mortgage. It's an important responsibility of Archibald, is to determine if a borrower has the ability to repay a loan. To determine if the couple is qualified for the mortgage, Archibald obtains the following information. Together, they have an annual income of $110,000. The annual property tax on the house is $2,200, and the annual house insurance is $980. So, monthly housing expenses. They would have to pay $1,294.56 for the mortgage payment itself. Annual property taxes. If they would need to put away 1/12 of this every month to make sure they have enough to pay the property tax, and they're going to have to pay 1/12 of their insurance. So that comes out to $1,559.56. Their combined monthly income, we know their yearly income is $110,000. Divide that by 12. Their monthly income is $9,166.67. Most lenders use the rule that the monthly housing expense should not be more than 28% of the month gross income. Can the couple afford the house? So they make $9,166.67 each month. Multiply by 0.28 to see what 28% of that, which comes out to $2,566.67. 67 cents. So yes, they should be able to afford the house. So the total cost of buying the house. If we go back to the beginning, their down payment was $12,000 plus the amount we had to pay on the house. So we paid $1,294.56 360 times. So that'll take care of our principal and the interest. And then they had to pay $4,560 in points. So in total, they end up paying $482,601.60 for their house. That's all for today.